Okay. Welcome to our week ahead presentation about the April 26th to 30th week. And with no time to waste, I leave you to read our disclaimers. And as you're reading, allow me to mention that with worries about the surge of the pandemic, with disturbing images and reports coming out of India, we open a window in what next week has in store for the markets. On the monetary front, the torch is passed from the ECB to BOJ and Riksbank on Tuesday for the interest rate decision, yet the main event probably for the week is expected to be FOMC's interest rate decision on Wednesday in the American session. As for financial releases, we get a number of high-impact data scattered throughout the week and from various countries. We highlight the release of the inflation measures for Australia, Germany, France, and the Eurozone, as well as the GDP rates for the Eurozone and the US. On the fundamentals, the importance of the path of the pandemic globally has been upgraded, while we also note the pace of the US economic recovery, as well as on a more local level, each economy could affect its respective currency. Now, with no time to waste, we move to the US dollar. This is the US dollar index, the 4-hour chart. Please note the downward slope characterizing the movement of the index over the past month, actually since the start of the month. As for important levels to the upside, we note the 91.30, which was the highest point yesterday, even higher the 92.15, and as even higher the 92.80. To the downside, we note the 90.75, the 90.25, and last but not least, the 89.65. We expect that overall, we will be keeping a bearish outlook for the index as long as it remains below the downward trend line mentioned before. Now, the weakening of the USD against a basket of its pairs seems to be ongoing for a third consecutive week, despite some hesitation caused by safe haven inflows due to the surge of the pandemic. On the other hand, we must note that the reports tended to highlight the possibility of the Biden administration raising substantially taxation, which also created some worries among traders. Also, US yields seem to remain rather soft, and should that tendency continue in the coming week, we may see them undermining USD strength. It should be noted, though, that the direction of the US yields could be substantially affected by the Fed's interest rate decision. The bank is widely expected to remain on hold at the range of 0 to 0.25%, and currently Fed funds futures imply a probability of 94% for such a scenario to materialize. The real economy seems to be making progress, and voices for some sort of tightening of the monetary policy seem to grow louder. On the other hand, Fed Chairman Powell, while speaking at the Economic Club of Washington, D.C., stick to the script and remain dovish, saying that the Fed isn't considering raising rates or easing up and won't for a while. As for financial releases from the US, we note the release of the durable goods orders for March on Monday, the consumer confidence indicator for April on Tuesday, the preliminary GDP rate for Q1, along with the weekly initial jobless claims figure on Thursday, and on Friday, the consumption rate for March. Moving now to the pound, and this would be cable for our chart. Note that the pair has been moving in a sideways motion between the 1.3990 resistance line and the 1.37. We expect that the sideways motion is to continue as long as the pair remains with these two boundaries. Nevertheless, to the downside, we note the 1.3845, which was yesterday's low point. Also, note that the specific level was tested numerous times to the upside as well as to the downside. While even lower, we note the 1.37, which is practically the lower boundary of the pair's sideways movement and was tested at least twice. Once was at around the 17th of April and the 14th of March. While even lower, we note the 1.3565. To the upside, we have the 1.3990, even higher the 1.4145, and the last bullish barrier would be the 1.4275. Now, the pound remained relatively stable against the USD in the past week, as we have mentioned. The improved economic outlook of the UK seems to have failed to boost pound traders. The data released from the UK were pretty good in the past week, as the unemployment rate dropped for February. Retail sales got a boost for March. British industrialists seem to be quite optimistic, and economic activity has expanded even faster for April. On the other hand, we must note that inflation ticked down, yet that tended to be overshadowed. Overall, such readings should distance even further BOE from the scenario of negative rates on the monetary front. On a more fundamental level, the intense vaccination program of the UK supports the notion of an improved outlook, given also the easing of the lockdown measures since the 12th of April. On the other hand, we would like to highlight the elections in Scotland on the 6th of May, which may pose some form of uncertainty, especially should pro-independence parties win. Overall, we expect that UK fundamentals could play the primary role in affecting the pound's direction, given the low number of high-impact financial releases in the coming week. Nevertheless, we would like to note the release of the CPI distributive trades for April on Tuesday, as well as the nationwide house prices growth rate. Moving now to the Japanese yen, and this would be JPY USD for our chart, USDJPY for our chart. Note that there has been a downtrend characterizing the pair's motion. That's since nearly the beginning of April. To the upside, we have noted the 107.65, even higher the 108.35, and the highest level noted is the 109.25. Even lower, we note the 106.95, the 106.25, and the 105.65. Now, please note that the RSI indicator is dangerously approaching the reading of 30, which could imply that should it be breached, the pair is oversold and a correction higher could be in the cards. Moving on to the fundamentals. Once again, the situation in Japan seems to remain severe regarding COVID, as Japan declared a short and powerful state of emergency for Tokyo, Osaka, and 2 other prefectures. The new measures are to be applied from the 25th of April to the 11th of May, and the press conference is to be held by Prime Minister Suga to explain the situation later today, Friday. Also, our worries intensify as the vaccination seems to remain rather slow, 3 months ahead of the Olympics. Hence, the possibility of the Olympics being cancelled tends to grow. On the monetary front, BOJ's interest rate decision is due out during Tuesday's Asian session, and the bank is widely expected to remain on hold, keeping rates at minus 0.10%. Currently, JPY OIS imply a probability of 93.33% for such a scenario to materialize at the moment. Now, overall, given the threats surrounding the Japanese economic recovery, the question that arises is how much more dovish BOJ could actually get. Reports are highlighting the possibility of the bank lowering its inflation forecast below the 2% target, and such a scenario could highlight the limits of the bank's current ultra-dovish monetary policy. As for financial releases, we note the release on Friday of Tokyo's inflation measures for April and the preliminary industrial output growth rate for March. Moving now to the common currency, and that should be euros against USD chart on the 4-hour time frame. Note the upward trend line, which characterizes the movement of the pair over the past almost 3 weeks. I would dare to say that the upward trend line was actually threatened yesterday, but the pair recovered to the upside, so we maintained it, and we maintain also a bullish outlook for the pair as long as it remains above it. To the upside, we note the 1.21 resistance line, the 1.2175, and even higher the 1.2280. To the downside, I would highlight the 1.1990, which was tested yesterday. Even lower, I would note the 1.1905, which tended to cause considerable commotion over the past month. And the lowest level noted would be the 1.1830. Now, on the fundamentals, Europe is still firm in the grip of the pandemic once again. It's characteristic that in Germany, the number of new daily cases is still at high levels, showing that the country is still in the 3rd wave of the pandemic. Yet there may be some light at the end of the tunnel as the area's vaccination program picks up pace. As per EU Health Commissioner Stella Kyriakidou, vaccinations are ongoing at a rate of 3 million doses per day, which is a considerable improvement. On the monetary front, ECB's interest rate decision last Thursday has left no doubt about the bank's dovishness. ECB President Christine Lagarde underscored that rising coronavirus vaccination rates and an improving economic outlook are positive signals, yet implied that the tapering of its PEP program was premature currently. As for financial releases, Euro traders are to have a busy schedule ahead next week. Now, on Monday, we get Germany's IFO indicators for April, and on Wednesday, Germany's forward-looking GfK consumer sentiment for May. Now, the heavy weight of financial releases is on Thursday and Friday, as we get Eurozone's, Germany's, and France's preliminary HICP rates for April and preliminary GDP rates for Q1. Moving now to the Aussie, and this would be AUDUSD for our chart. Note that the pair has been moving in a sideways motion, and that has been happening for the past 1 week. Important levels which we have noted are to the downside the 0.7725, the 0.7665, and the 0.7595. To the upside, we highlight the 0.7785, the 0.7850, which was tested practically at the mid of March, and even higher, the 0.7905. On the fundamentals of the Aussie, now economic activity in Australia seems to be picking up pace, as indicated by April's preliminary PMI figures, and that could prove to be a positive for the AUD. On the other hand, we also intend to focus on the release of China's NBS PMIs for April on Friday's Asian session, with most interest being placed in the manufacturing sector, as that could affect Australian exports of raw material. Yet before that, on Wednesday, we also get Australia's CPI rates and could create substantial volatility for the Aussie. Overall, though, we expect that market sentiment could considerably move the Aussie as a commodity currency, and fundamentally, we would highlight the path of the pandemic along with the US-China relationships as issues to be considered for AUD's direction. Back home in Australia, we would also like to note that Perth is entering a lockdown for 3 days that tends to create some worries as well. On the bright side for AUD, iron ore prices seem to remain at rather high levels, and so do copper prices, two of the main products Australian exports. Moving on to the CAD, and this would be USD CAD for our chart. Now, the CAD has also been moving in a sideways motion, yet there seem to be some bearish tendencies from time to time for the pair. Note that the pair has gotten, I would dare to say, some moving to the sideways bias motion, while at the same time, note that to the upside, we have mentioned the R1, 1.2520, above that, the 1.2610, and the 1.27. To the downside, we note the 1.24, which was last tested at around the 17th of March, even lower the 1.2315, and the last bearish barrier would be the 1.2230. Now moving to the fundamentals of the CAD got a boost practically against the USD in the past few days, primarily by BOC's interest rate decision. You can see the long red vertical downward candlestick which characterized the movement at the moment. The bank remained on hold at 0.25%, as was widely expected, yet decided to adopt a more hawkish tilted tone, expressing considerable confidence and tapered its bound purchasing program by 1 billion Canadian dollars per week. Now, the decision was a result of the improved economic outlook, as the Canadian economy rebounds maybe even quicker than expected. Oil prices, on the other hand, seem to be losing some steam, as the surge for the virus globally tends to create some worries for the demand outlook of the commodity. Yet the virus is causing trouble also in Canada, as the country is struggling with the third wave of the pandemic. As for financial releases, we note on Wednesday the release of the retail sales growth rate for February, as well as Canada's GDP rate for February on Friday. Now, before we leave you, I would like to make a small general comment. Overall, the Fed is expected to dominate the scene, at least until Wednesday, yet financial releases such as the preliminary GDP rates for the US and the Eurozone and the inflation measures for Australia and the Eurozone could also play a key role. We expect that the USD may have the initiative over other currencies, while traders' attention is expected to be split between financial data, monetary decisions, and fundamentals. Now, besides the FX market, we expect gold prices to retain their negative correlation with the US dollar, Yet movements in the US yields could alter that to some degree. As for stock markets, given that the US hasn't opened yet, market optimism could be the key factor to watch out for. Yet also the intentions of the US government to increase taxation should not be underestimated, nor should the effect of any possible earnings reports which are due out next week. We hope that you found this report useful, and if so, don't forget to subscribe and to share. From all of us here at IronFX, best wishes for solid trading.